The most overlooked area that we see in all of tax is
almost 500,000 people are missing $1 billion in tax credit that the government wants to give to them.
look at your investments. What are you investing in, and are you maxing out your 401k?
Did you know that? Those things are out there for you.
It is what it is. I'm like, I know. That's the whole purpose of this stupid podcast, is so you know it's not, it is what it is. There's stuff you can do. All right, welcome to this episode of the Hidden Money Podcast. We are going to be covering the top 5 most overlooked areas that we see in our clients. And we're not just talking write-offs. Here are the top 5 write-offs. These are the top 5 areas. And before the episode, Mike, we were chatting about this crazy stat. And this is just the earned income tax credit.
That's just one
credit.
Small credit.
One area of one credit available. 500,000 taxpayers missed $2,000 of EITC average earned income tax credit. That is $1 billion of unclaimed tax credits that's owed to those people that they never claimed because it was just overlooked.
There's a problem here. This fires me up, man, because seriously, this is one small area of the tax code, one tax credit, and just looking at this tax credit, 500,000 people missed out on $1 billion of credit. You take the average, that's $2,000 each. Are you so wealthy that $2,000 doesn't matter to you, that you're okay with not keeping that money that belongs to you? And are you so selfish where you'd rather that money go to the IRS and get flushed down the federal government's toilet versus going to a good cause, or at least your life? Seriously, that's just one credit. Mm-hmm. This is ridiculous.
And I don't think it's kind of malicious. Like, people are just like, I'm not going to take the credit. They just don't know. They don't know better. They either self-prepare their own tax return, or they just don't have a good...
You're saying I shouldn't call it selfish. Okay.
Yeah. I think that's just...
Maybe
they
ignorant.
know what they know.
I'm not trying to be mean, guys, but seriously.
Ignorant.
$2,000? You couldn't use that?
Yeah.
I could use it. My church could use it. The orphanage we sponsor could use it. Come on, man. Yeah. Learn about these deductions and these top 5 areas. There's a whole lot more, but that's what we're going to walk you through in this episode.
Yes. And so the first big deduction, or the first big area that we see that people aren't taking, is just timing. Timing plays such an important role in your tax life, because you could have a tax year, like let's say it's 2026. Let's say you're 2026, you're projected your business is going to grow, or you're just doing really well on your sales job as a W-2 earner. You have a high year of income. But next year, maybe your income's going to be down. So your tax bracket is going to be higher this year. So let's front load some expenses. Let's get some prepayments out there. There are many prepayments that you could do. Like, you can prepay rent up to 12 months. You could pay your cell phone, insurance. You could prepay really strong vendors that you know are going to be around. This is services you're going to use for the next year anyway, front load those expenses in the high year and pay them all for the next year when your income's projected to be low. Pay them in that high year and get a higher tax deduction for that cost you're going to incur anyway.
Yeah, I just recently met this week, I guess yesterday, with a newer client of ours. He's a W-2 taxpayer. And he's been told, hey, as a W-2 taxpayer, there's nothing I can do. I can't take expenses. And then we looked at his last year's tax return, and he gets a commission check at the end of every year that comes as a 1099. He's like, I'm just an employee. Where can I take deductions? I'm like, you get a 1099. You are a self-employed individual. Do you pay for your cell phone and use it for business? Yes. Do you have internet? Yes. Do you have a home office so you work from home? Yes, I work from home twice a week. We just, in that 15 minutes of call, discovered a way to mitigate the entire commission income. $40,000 in income he was going to pay tax on, that he did pay tax on last year and the year before and the year before. This year was going to be a little bit higher. And what we did also was we timed the deductions. This year was going to be a bigger income year. So he prepaid his cell phone, or he's going to prepay his cell phone. He's going to prepay his internet, just enough to get his income down to 0. That's the way you do it.
Yeah, that's timing. Just planning. And go back to our previous episodes of accounting and the importance of record keeping, because you can't make these timing decisions unless you know what your income is. It's hard to also predict the future, but generally speaking, some people a lot of our clients have big windfalls, like a stock option hits, or they sell.
We've had a lot
stock.
of NVIDIA clients this year that never had to pay taxes, and they're suddenly getting these multi-million-dollar stock options. And they're like, do I really have to pay all this tax? Our HR people told me I'm going to have to pay $700,000 in tax. I've never made that kind of money. We're like, no, you don't. Let's show you.
Yeah, here's how you not. Here's how you don't. So you could predict those big windfalls sometimes with a degree of predictability, just saying, hey, I know these income items are going to hit, or you're a business owner and you have a big deal come through. This happens with attorneys. We have an attorney client who he's contingent fee, right? So if he has a big case and he wins that case, he's getting paid. So we know that there's going to be a spike in income if he wins a multi-million-dollar settlement. He's going to get paid.
And that's a perfect example to discuss the timing. So a couple of years ago, he calls up and says, hey, look, it's looking really good. The jury's meeting. We're most likely going to win this case. And we took a look at their contract they had with their client, changes around a little bit to delay the payment 2 weeks. And that gave him the whole next year. So he got that payment, and he did win big, and got that contingent payment in January the next year. So that gave him an entire year to mitigate that huge amount of income. If we wouldn't have done that, and he wouldn't have utilized the timing, he would have paid tons of taxes on that because he wouldn't have had nearly enough time to implement all those tax strategies.
Yeah, if any time. I mean, if you receive a payout in December
20th, what are you going to do?
What can you do? I'm on holiday. Sorry. Yeah, and we have some clients who actually are in that situation. And think about the corporations are doing this. If you're an employee, I see so many of our W-2 employees who get bonused out right near the end of the year. Like December 20, like the company's holding on to all this cash for 12 months. And then in December 20th or December 30th, they're going to give you a big bonus because they're going to get their expense.
They need their tax deduction.
They want their tax deduction, and they're going to push that liability to you. And I have tried so hard because I have two clients in mind that this happens every year. They'll get a multi-million-dollar bonus. Late in December, they're like, can I do this? Can I do this? I'm like, literally, I can try. But they're doing it too. The partnerships, the corporations, that's what they're doing. And so timing is very important. So if you're a business owner and you're in control of your timing, you can do this too.
Could you use an extra $1,000 in your pocket? How about an extra $5,000, $20,000, $100,000? Well, there's a good chance you are overpaying your taxes, and you could have that money in your pocket versus sending it to the Treasury Department where it's getting, quite honestly, flushed down the toilet. How do you know that? I mean, sure, it sounds like a gimmick, right? That's why we have created a new tool, a tax assessment tool, to check out your tax health. It's your baseline. See, are you most likely overpaying your taxes or not? And where might you be overpaying? Where might you be missing opportunities? Go to revotaxpayer.com, take the health assessment, and see your score for yourself. You don't have to talk to us. Just see where you stand, and are you overpaying too much taxes? If you couldn't use some extra money in your pocket, go ahead and ignore this. Don't go there. Keep overpaying your taxes. revotaxpayer.com.
You could do this too. So that's our first one is timing. The second one.
Let me bring in just a couple other practical ones. Like some people are just W-2. They can't time expenses like that. But you can time your itemized deductions, right? So I just want to throw that out as a name for you.
Sure.
Especially now that the One Big Beautiful Bill Act has passed, your state income taxes or local property taxes, you can now deduct up to $40,000 on your itemized deductions. So if you have a high income year, you prepay your real estate taxes. If you're a normal person that normally gives to charity and you know you have a high income this year, but next year probably not, or you know it's going to be lower, double do your charity now. Give the charity before December 31st because that's when you can use the deduction and you get a much bigger tax benefit this year than if you did the exact same charitable contributions next year. Timing is super important for everyone, not just business owners.
Yeah. Bunching, if you just do some research on bunching,
there you go.
That's charitable bunching, property tax bunching. You can time your capital gains on your portfolios. Don't let taxes dictate when you sell. But you can also pull the trigger on some things now or maybe in a couple weeks when the calendar turns, right? Yep. So the second one that we see often is just entity structuring. We see so many people and they just come in. I met with one 2 days ago where they've stacked up a bunch of losses in their business. They started this business and they actually do porta potties. So all this depreciable property, they got a loan.
It's a fun business.
Yeah, it's a crappy business. But
No pun.
they went to the bank and got a loan and they bought a bunch of these porta potties. Well, that's all depreciable. So they got a lot of deduction up front. And so they have this what's called a net operating loss. They have all these losses that have just been following them. But now they're starting to make money and they're making like $4 or $5 million doing this business.
The porta potties?
Yeah.
It's not such a crappy business.
It's not.
Nice.
But now those losses have run dry, but they've been a Schedule C this whole time. They've been a sole proprietorship, and now all the net operating losses are going to be used, and they're going to be left over with net income. So I met with them 2 days ago. We're going to put them in we're going to restructure them now, like quickly, and retroactivate an S election, and that's going to save them a ton in tax. So entity structuring is something that we see all the time. People always come and say, I have it in an LLC. Well, that's not always good enough. An LLC is just a liability protector. It's not doing anything for you tax-wise. So we actually have to decide, do we want you in a C-Corp, S-Corp, partnership? What makes sense? We need to diagnose and do what's right for you in your personal situation.
Really quick, to drive home that example. So what was the net income going to be this year about?
Oh, he was like 1.5.
So 1.5 million, the way it was going to be taxed on a Schedule C, he would have paid 15.3%, he and his wife on both of their share of the first $170,000. Then 2.9% on another 1.3 million. 2.9%. That's $40,000, $50,000 in extra tax. If they would have waited to meet with you until January 1st or 2nd, had the wrong entity structure, guaranteed they were going to pay an extra $50,000 plus the original FICA. They might have paid an extra 100 combined $150,000.
It's like 5 more porta potties they could have bought.
A porta potty costs $30,000. How much does a porta potty cost?
I don't know. Probably like 5 or 6, I would guess. I don't know, with the maintenance and stuff.
Wow.
You drop them off. You drop them off at venues, concerts, work sites, and then you just have someone go there, clean them, pick them up, transport them. It's transport costs.
This is Revo's Partners Tax Planning 2026, baby. Let's go into the business of crack.
It's lucrative.
It is. It's all bonus depreciation eligible. Nice.
Yep, absolutely is.
All right, that's a bonus. That doesn't count for our 5 areas, but go buy a porta potty business.
Yeah, do that. So the third thing that we often see also is people do not use tax advantageous investments. And this looks like a number of things. One, 401ks. Max out your 401ks. I am a strong believer, and I believe when I invest my money in the New York Stock Exchange, I am betting on America. I invest in like the S&P 500. Those are the biggest corporations that our country has. I have a degree of confidence that over time, those companies are going to succeed.
This is an area where Kevin and I don't always see.
But I don't have a lot in there. I max out my 401k, which is what, 25 grand a year.
26.
So that's a very small amount of my portfolio, but I still get into it because it's tax advantage. I get the tax deduction today. I don't do Roth.
I buy some gold in my 401k too.
Yeah, that's not tax advantage.
In the 401k.
Oh, in your 401k.
It's tricky. But yeah, you can't take possession of the gold. Yeah. So I bet on America, but I also bet on gold.
Yeah.
Yeah.
But I also do oil. We do real estate.
Yes,
we diversify, but everything I do now, it's almost kind of, it just absorbs in my mind. Every dollar I spend, I'm like, can I deduct it? Everything I want to do is tax advantage. Drives everyone nuts in my life, but that's okay. That's what I
love
for.
I love that part about you.
Yeah. So look at your investments. What are you investing in, and are you maxing out your 401k? Are you doing an IRA? Do you have your kids set up on, if you're a business owner, are your kids contributing to a Roth, a spousal IRA?
Or simple HSA, right? Do you spend a couple $1,000s or $500 every year on health supplies or on medical expenses? Use an HSA. Almost every employer has them. If you're self-employed, create your own HSA and let the IRS subsidize those medical expenses. If you're not doing it, you're just missing out on money that's yours. Or really what you're doing is overpaying your taxes. Honest to God, I'm not exaggerating. That is what you are doing. So stop it.
And an HSA may seem like a small thing, but these things add up.
Yes.
Like 2,000 here, 3,000 here, 5,000 here. Oh, home office, we're going to do that. Like once you start compiling this playbook and putting it together, you're like, that was hundreds of thousands of dollars that we've accumulated in all these small things. So don't ignore the $2,000, $5,000 HSA, or dependent care credits and all these things that you're available to take.
I mean, another example, let's just say you're only saving $2,000 of tax a year by doing something, right? Consider the time value of money. If you were able to put $2,000 away every year for the next 30 years, it's not just going to be worth 2,000 times 30 or 60,000, right?
60, very good.
It's going to be worth a heck of a lot more with the time value of money. So it compounds. Every dollar of tax you save today is many dollars in the future when you don't want to work anymore, when you want to put your kid through school, when you want to retire, when you want to buy that vacation home or take your family on that Alaskan cruise. Save that money. But again, it's better when we can add those up instead of just 2,000. You add all these things together and you're saving hundreds of thousands a year in taxes.
Yeah, my argument always is that when it comes to tax law, there's a lot of things that are only available to those who make like under 400,000. Like the way, and I don't care what the news says, generally the wealthy pay the majority of all the tax. They do, because they make more, their tax rate's higher, they get phased out of credits. Like the stat we led off with 500,000, the EITC. If you're wealthy, you can't make it. And wealthy for that could be like 150 grand.
Yep.
So the importance of tax planning is I'm going to make $1 million, but I'm going to get my income under the threshold and be eligible for EITC.
With tax?
I'm going to be eligible for college credits. I'm going to be eligible for all these other benefits that are available to the kind of lower income in tax law, the lower income areas.
That's not cheating.
No, that's
Some
why.
people call that cheating. That's not.
We didn't even get into like college, like FAFSA. And if you have children going to college, it is so important. If you show them a tax return, you're making $1 million, you're out. Like they're not going to help you out. But if you come in there and say on your tax return, I made zero money, but in your bank account you made $1 million, but because of tax planning, we got your income so low, suddenly you're eligible to get some really favorable college financing if need be.
Yeah, or maybe all of it, unless you just want to pay for it all out of pocket.
Yeah.
I mean, seriously. So they're here to make tax advantage investments. And there's so many different kinds. And check out all of our episodes. We have so many episodes on different kinds of tax advantaged investments. Another area that we see people making mistakes or failing to utilize the power of the tax code to build their wealth and grab that hidden money is overpaying estimated taxes. Talk to me about that.
Some people they're like, I'm going to pay 37% of every dollar I make. I'm putting 37% away. That's not how tax brackets work. That's not how tax planning works. And then they remit those and say, I just want to sleep at night knowing I've paid my taxes. I could kind of get behind that in a weird way to where I'm like, there is a degree of security knowing I don't owe the government something. There's some truth to that, but it's still asinine. All right, the work is done. We've done the planning, we've done the compliance, but one thing still remains out there that we can't control as much as we want to control, and that's the federal government. If we could figure out how to control the IRS, our jobs would be a lot easier, but we can't. So in the event that you're selected for audit, that comes with some stress and it comes with some cost. Given the strategies and the complexities of your tax return, more than likely you do not want to defend this by yourself. So you want to hire a professional, hopefully us, the professionals that prepared your return, to defend what we prepared. So in the event that you are selected for audit, the fees can range drastically on an hourly basis from $3,000 to $50,000, $60,000, $70,000. So it just depends on the scope of the audit, how far they want to look and how deep and how hard they want to make this, which we have zero control of. One way to hedge your risk against this is to purchase this audit defense plan. This audit defense plan is going to be a one flat fee quote for federal, and we're going to give you one for state if you're in a taxable income state. Then if you pay that premium, no matter if you're pulled for audit, you are going to be covered from our team to defend this audit at no additional cost above that premium. So you would pay the premium up front, and you are locked in for 3 years. If in the event that you're audited, we are going to defend and fight tooth and nail to defend the positions that we took on your tax return at that set premium cost. So you have to weigh the risks. Is it worth it? The likelihood of getting audited has historically been low, but they're going to be on the rise. They are going to be going up. And the more aggressive positions in tax planning you do, the more eyes that are on you. And I don't want to fearmonger, it's just the truth. And so just protect yourself. This is a great plan, and we look forward to serving you in the event of an audit. You're still giving the government all this money up front at no return for you.
No interest. The government doesn't pay you interest when you overpay your taxes. And if you want to see a lot more on that, look at our previous episode on tax refunds and need to get them early.
Yeah. And so if you overpay your taxes in Q1, Q2, And then we do some tax planning in Q3 and Q4. Hopefully you're not paying any more estimated payments, and we're undoing the overpayment you did in Q1, Q2.
Yeah.
So the importance of record keeping, proactively planning throughout the year with your tax advisor to say, hey, I had a good quarter, but next quarter, we need to know the seasonality of your business. We need to understand the ebbs and flows of everything.
Yeah.
And that way we could truly plan, because when we're looking at your tax plan, we're not looking at it a quarter by quarter basis in which you pay your estimates. That's all well and good for what the IRS wants you to do. But at the end of the day, you could be making a ton of money Q1, Q3, and then you could remit those taxes. But Q4, maybe you invest a lot into capital expenditures, bonuses, salary.
I have a perfect example. One of our long-term clients, talked with him this week, and we've been working on a deal. He was scared. Their business has been booming, and he had our team calculate what his estimated taxes need to be for Q4. And he was going to owe just the federal government, not counting the state. He owed the state a lot too, $140,000. And that's what he's going to have to pay. And that was going to come out of his pocket. Instead, though, this awesome, fun client went and found a tax advantage investment. He used $150,000 to get into it. Instead of paying $140,000 now, he's not going to have to pay anything to Fed or state, and he's going to get a refund of some of his Q2 and Q3 payments. So,
and you're in something that's is this kicking off ROI?
It will. It should kick off very good ROI. So,
how do you say, how do you, seriously, play devil's advocate? How do you say no? I guess there's risks in that investment.
There's risk in the investment. And the investment's going to take a lot of work.
So yeah, but the downside is the risk.
The devil's advocate would be something.
Why would I not do it?
You're going to have to work hard to make that new investment work well. You could lose money. Why not just pay your taxes and relax?
You have zero ROI, you lose your money if you pay the government anyway. You're not getting, like
you said, the government's not giving us an ROI?
No.
Not generally, no. They're not even going to give us our Social Security. So
no.
Yeah, I don't know how unless it's just like, hey, remember that guy that we met with at that function, that outdoor function we went to a while ago when we met our state attorney general? Yeah, and he's like, man, I do great. We asked, how are you doing in taxes? He's like, man, I do great. I only pay about 32% of income. We're like, 32%? He's like, yeah, I've got a great CPA. We're like, you shouldn't be paying 32%. We started talking more in detail and said, you could get more like 15%. He's like, no, man, that's just too much work. It is what it is. He was the devil.
It is what it is. It is. He said that over and over, and it was like nails on a chalkboard. It is what it is. I'm like, no, that's the whole purpose of this stupid podcast is so it's not. It is what it is. There's stuff you could do.
We recommended you listen to the podcast. We tried to convince this guy, and after about 10 minutes, both of us just like, I
got to move on because you are not going to get it.
Yes. Yeah. Please watch the podcast. So that was the devil's advocate. It is what it is. Pay the government your money. Don't make it grow for you.
Yeah. In the last, number 5, the most overlooked area that we see in all of tax is you just don't communicate to us as your CPA. You do things, you get into deals, you may sell some things, trigger income, or you make a ton of income and you don't even let us know until it's time for the tax return. You're like, I owe what in tax? I'm like, dude, I have reached out to you a handful of times in the past 6 months and you just don't care.
Or I'll tack on to that. You have a tax preparer, not a tax strategy or tax planning partner. It's a lot of people. That's what most CPAs are. They're tax preparers. And you do communicate with them. They reach out to you in January, February saying, hey, send me your stuff. But you don't communicate with a tax strategist to figure out what are you leaving on the table. Kevin was mentioning, we talked about the EITC tax credit where people are missing over almost 500,000 people are missing $1 billion in tax credit that the government wants to give to them, that the law says they should give to them, right? That's one small credit. Let's talk about the research and development credit. How many new clients or prospective clients do we meet with every year that are eligible for the R&D tax credit and never knew about it?
Without a percentage, I would say all the business owners out there, even we are. I'm exploring it for us.
We are a tax consulting firm, and we are eligible for the research and development.
We are getting R&D.
So you have bars and restaurants are eligible for it, and the restaurants are also eligible for tips credit. They're also eligible for the worker, the work opportunity credit, tax credit, WOTC. There's so many credits.
If you start a 401k and you're a small business startups get a huge credit for just giving your employees some sort of 401k plan, and they contribute to it.
This year we instituted, because it was the right thing to do, giving paternity and maternity leave as firm-wide to our team. Guess what? The government's going to subsidize part of that. Did you know that? Those things are out there for you. Learn. The lesson I want you to learn is speak with your CPA. And if your CPA or your tax preparer is not a tax strategist, go speak with another tax strategist and find out, what are you leaving on the table? Because more often than not, and I'm saying this is probably you who's listening right now, you the listener, you are probably leaving money on the table with your taxes each and every year. Find out. It's your money. You've worked hard for it. Please don't just give it up. Use it. Grow our economy. The economy needs you. Our country needs you to be a good steward of your money. Please do so. That's your patriotic duty.
Well said. Well said. Well, any closing thoughts? I think those are the 5 that we kind of see. I mean, there's a lot. There's a lot of underlooked areas, but in a 20, 30-minute episode, it's hard to tackle it all. But I feel like those are really good.
Yeah, I would say if you want to hear a lot more, Kevin and I could talk about this for 10 hours and still not get through the list. Mention in the comments. Maybe we'll do a special video for you or a seminar for the 20 of you that actually want to hear 8 hours of these things. And we'll get through maybe a third of them, right? But please do subscribe onto our podcast, comment, share it with people, share it with your tax preparer, share it with your friends. I promise you're more likely than not paying more taxes than you should. And just about everyone you know is also doing it. Spread that gift, help people be better stewards of their money and better patriots to this great nation by spurring on our economy and not flushing their money down the toilet with the Department of Treasury.